Hello, everybody. In Accounting 230, 42186, I believe is the course number. Hey, we're going to go into chapter 6 now. You've all gone through everything that you learn in 110 for the most part. So you're all experts in 110. You know your debits and credits now. You know what the general ledger is and how to post journal entries and use T accounts. So chapter 6 is going to introduce us to some new material, and it's along the lines of sales revenue, receivables, bad debts expense, and this can be a pretty tricky little chapter. So let's take it a little bit at a time, divide and conquer and all that, okay? Chapter 6 in 230. This is my 3 o'clock in the afternoon class. Accounting for sales revenue. The revenue principle, we know this, right? The revenue principle, revenues are recorded when they're earned. Take a look at these four guys here. Sales revenue. A company bills out $1 million. A store, let us say, okay? A store has cash register tapes and billings of $1 million. Well, guess what? They're not going to collect that whole million because what do customers do? Customers return things. You bought a garment from a clothing store and it didn't quite fit properly when you got home and you weren't allowed to return it to the store. That's going to be a reduction of your net sales. But as you know, you never debit sales. Never debit sales. And I have the guitar right here. If you want me to sing the song, I will, but I'll only do that as punishment. You never debit sales, you never debit sales, etc. What you do debit are these contra revenue accounts, sales, returns, and allowances. You returned a garment because it didn't fit right. You brought the garment back and the store said, look, you paid $50 for this. I'll knock 25 off the price, you keep it. That would be an example of an allowance. A sales discount is a discount offered by companies to their customers to encourage early payment of the bill. A sales discount or cash discount is a procedure where you get the invoice and you see that you have 10 days to pay the bill. And if you do pay it in 10 days, you get say a 2% discount. Otherwise, you pay the whole bill at 30 days. Credit card sales. You go to Walmart or Costco or one of the stores in town, and you hand them your credit card and you buy $100 worth of goods. They swipe your credit card and they are not going to get $100 in cash. They're going to give themselves credit for selling $100, so they will credit sales or sales revenue, whatever. But the cash they're about to debit is not going to be 100, it's going to be 98, say, because Visa charges a fee to the seller. So that's another cost of doing business. And later on the chapter, we'll get into bad debts where people just don't pay you. And we'll talk about handling that, huh? Credit card sales. You know, you see some small businesses once in a while, maybe a small restaurant, and they say cash only. Well, that's because they don't want to deal with credit cards. They don't want to pay the fees. Of course, they're limiting their potential growth by not using a credit card, allowing the use of credit cards. But companies use them for a lot of reasons, to increase sales. My goodness, can you imagine if Costco was all cash? Their sales they'd be out of business in 2 days. You use credit cards, so you avoid providing credit. You don't have to worry about giving credit to customers. You don't have to look them up. You don't have to worry about bad checks. Fraudulent credit card sales not going to be the responsibility of the person involved. Not going to be responsible for fraudulent credit cards. And naturally, when your customer uses a credit card, you get paid immediately. I mean, it could be an hour, it could be minutes, maybe at the end of the day at the latest. That's why I say credit cards are really cash, okay? So when credit card sales are made, the company has to pay the credit card company a fee. And look what it says up on top. That is a contra revenue account. contra revenue. It has a debit balance and it is married to sales. Remember, we say in this class that all contra accounts are married to somebody else. Accumulated depreciation is a contra asset account wedded to the machinery, to the fixed asset. And we're going to have the same thing here. So here we go. Take a look at this. You need to understand this little phrase like the back of your hand. When customers purchase on open account, they may be offered a sales discount. 210 net 30 is how you read that. 210 net 30. You get a 2% discount if you pay the bill within 10 days. So if it's $100, you only have to pay $98, 2%. And that's a mighty, mighty big discount. You'd be crazy not to take that discount if you were the buyer. 2%, 10 net, the full amount, 30 days. The way you read that is 2%, 10 net 30, 210 net 30, 2% discount if you pay within 10 days. Otherwise, you pay the whole net in 30 days. 210 net 30. And that's our second of 3 contra revenue accounts. Let's just take a look at this. I hope you find this interesting. With discount terms of 210 net 30, a company saves $2 on $100 by paying on day 10 instead of the 30th day. Well, 2% doesn't sound like a whole lot, does it? But this is not 2% a year. This is 2% for 20 days. This is 2% for 20 days. You gave up the money 20 days early to save 2%. So let's take a look at this. And here's why you'd be nuts not to take that discount. $2 over the 98 that you're actually going to spend, not over the 100, means that in just 20 days, you earn 2.04% on this transaction. If you took this $100 to any bank in town and deposited it in their highest paying savings account, you would end up with less than 1%. And that's over a whole year. When you take that 2% 10, you're giving yourself a 37.5% return. How do we figure that? Well, every 20 days, you're earning 2.04%. How many days are in a year? 365. You divide that 20 into the 365, whammo, 37.5%. So if any of you want extra credit, in fact, I'll guarantee you an A, if you can bring me to a bank where I can earn 2% every 20 days with no risk, I guarantee you'll get an A+ in this class, okay? Sales returns and allowances. Why do people return things they're damaged or they just didn't like it when it got home? Didn't work properly, not what you expected. These are called sales returns and allowances, huh? It is another contra revenue account. So we have 3 contra revenue accounts. We have an account called gross sales to begin with. That's the amount you build out in total, gross sales. But you know you're not going to collect them because people are going to return things, sales returns and allowances. People are going to take advantage of your 2% generous discount, and many customers use credit cards. I mean, I guess I'm like most people. I use credit cards for almost everything. It's automatic. It's so easy and convenient. Companies record credit card discounts, sales returns, allowances separately. You want to know these things. You want to know how much of your sales, your credit card sales are costing you in fees. You want to know how many people are taking these discounts. And you certainly want to know how much returns and allowances there are. So think of the sales revenue at the top. That is gross sales. Gross sales, meaning the total that you actually billed out to the world. But at the end of the month, you had to pay these credit card discounts. People deducted money from their payment by paying within 10 days. And naturally, customers returned things or negotiated a lower price or something. This gives you what are called net sales. So this is your first template you got to be very familiar with. It's the start of a new, much longer income statement. Gross sales minus these three contra accounts gives you net sales. Net sales. Net sales. When companies allow customers to purchase merchandise on an open account, the customer promises to pay in the future. And when we say accounts receivable, we're talking trade receivables. Trade receivables and accounts receivable have the same exact meaning. Trade receivables are business amounts owed to the business for the credit sales of goods and services, okay? We give credit to somebody. We check them out before we do business with them. And we say, okay, we'll ship you this amount. We trust you to pay me in 30 days. Classic accounts receivable, trade receivable. Non-trade would represent money owed to us other than operating type activity. What we're talking about here probably is a loan. Maybe we were in a position where we loaned money to somebody, and that debt that they owe us is not accounts receivable. That would be notes payable. You could have different things. This factory where I worked, much of my working world was a small place. We had about 60 people. And somehow I got in the habit of giving employee loans, employee advances quite a lot. And I never got burned with that. Somebody would come to me on payday. Geez, I'm a little short, Bob. Can you give me $50 and I'll take it out of my next check? We did that a lot. That would be an example of an employee advance, that debt, an employee receivable, okay? And trade receivables are short term. We know what long term and short current assets and other assets. Okay. All right. Are you ready to put your thinking cap on now? Here we go. Here we go with the toughest part, I guess, of this little chapter. But I think it's interesting because what you're going to learn now is about bad debts expense. Bad debts result from credit customers who will not pay the amount they owe, regardless of what we do. Okay? So every company in the world that issues credit is probably going to have some bad debts expense. Okay? Now, here's the theory of what we're going to be learning now in the next 5 minutes or so. The matching principle says we have to match what? That's right, revenues and expenses. So in this particular month, we had, say, $1,000 of sales. We have to estimate, we have to guess how much of these people are not going to pay us. It's an inexact science, but it must be done every month on what accounting calls a systematic and rational basis. So most companies record an estimate of the bad debt expense with an adjusting journal entry. So here's another adjusting journal entry that must be done every month. Deckers estimates they have a bad debt of $4,685,000. Okay, they gave us the number. So our journal entry is going to be a debit to bad debt expense, a debit to bad debt expense, and take a look at the credit. It's a credit to an account called allowance for doubtful accounts. It is another contra account. It is a contra receivable account. And just as we saw earlier in this lecture, we saw that gross sales minus credit card sales, sales discounts, and sales returns and allowances equals net sales. We're doing the same thing here. We're going to take our accounts receivable number for the aging, and we're going to have an offset to that called allowance for doubtful accounts. And when we subtract this from the receivables, we're going to get something called net receivables. Net receivables, okay? Just like you have net sales, just like you have book value, net book value on an asset. Now, to make things sound a little easier for you, in this part of the chapter, you really have just two-line journal entries. Two-line journal entries in regard to bad debt. You record bad debt expense at the end of the month. We just said it was an adjusting journal entry. So at the end of the month, you come up with your estimate for that month and you credit the allowance for doubtful accounts. And this is how it's going to look on your balance sheet. You're going to have accounts receivable, whatever that number is, less the contra receivable account, which is an asset account with an opposite balance, meaning it has a normal credit balance. Pull them together, subtract it, you get net receivables or net realizable value of accounts receivable. This is the amount they actually expect to collect. They might have $1 million here and 50,000 here, and they only expect to collect 950. Okay, so this estimate must be done at month end. And making your life a little easier, try to remember that this journal entry where you debit bad debt expense is only done one time each month. You're never going to debit bad debt expense more than once, and only at the end of the month. Okay, so let's go a little bit further here. Now, I told you there were two two-line journal entries. We just looked at setting up the bad debts expense, okay? What happens when we know who the bum is that's not going to pay us? When we're coming up with our estimate of the bad debt expense, it's a guess. It's just that. It's an estimate based on our history. Now, we're early in the month. We realize that a particular customer is not going to be able to pay us. We see in the newspaper that he went out of business, or she called us and was full of apologies, and she said her company's just doing terribly. There's no way she'd be able to pay this bill, and she's given us a courtesy call, that's all. Well, when it's clear that a specific customer's account will be uncollectible, now we can remove it from the AR aging. And we're going to remove it from the aging, of course, by crediting accounts receivable and debiting the allowance for doubtful accounts. Okay. So here, again, they're giving us the number. They're not asking us to figure it out, as we will shortly. So Decker's write-offs, and these are real numbers, by the way. So that's $6 million worth of people that are not going to be able to pay Decker's, okay? Look at our journal entry. Look at the journal entry. They knew that I wasn't going to pay them the $6 million. The Bob Company was not going to pay the $6,969,000. I went out of business. I have no assets. They're not going to collect a penny from me. Now they are going to reduce the accounts receivable with this credit for that $6,969,000, and notice the debit. The debit is going to go to the allowance account. Think of that allowance for doubtful accounts as an allowance your mother gave you, but you can only spend it to reduce accounts receivable. So you have two-line journal entries. One, debit bad debt expense, credit the allowance, and then you debit the allowance when you know who the party is who's going to be unable to pay you. And we need to work through that, huh? Now, here's something I'd like you to understand. Assume what we're going to see here is what's the impact of writing off of bad debt? Well, it has no impact on anything, really. And that's what I want to demonstrate here. Assume before the write-off, Decker's accounts receivable was 62.6 and the allowance was 13. Then they wrote off that 69. Okay, so let's take a look at this. And let's understand this. Before the write-off, accounts receivable was 62 million, right? And the allowance was 13,069 for net receivables of 49,571. Now we wrote off the 6,969. Well, remember our journal entry. We debited the allowance for doubtful accounts because now we're allowed to spend it. That brought this down to 6,000,001. We credited receivables to reduce that. Notice what the point is. Your net receivables don't change with a write-off. And the reason is because we're only switching two elements of the net receivables. This is the plus, if you want to call it that. That's your total receivables minus this anticipated group we're never going to collect equals the net receivables. When you actually write somebody off, there's no impact on anything really, except the receivables and allowances change by that amount, okay? It doesn't affect the income statement, and it really doesn't affect the balance sheet. Your net receivables are exactly the same. Now, here we go. Now we have to figure out what the bad debt expense should be. They, earlier in this chapter, we just looked at it, they gave us the number, showed us the journal entry, and we really need to understand that. So here we go on how to calculate it. And you're going to learn there's two methods, the sales method and the AR method. The sales method is not a very good method. There's a lot of flaws to it. I would be very surprised if there are many companies all who would use this method, other than how easy it is, okay? So on this method here, we're going to look at the month's credit sales. The month is ended, and we had $2 million in sales, to pick a number, and 400,000 of those sales were cash. So our credit sales were, say, $1.6 million. We're going to take that $1.6 million and we're going to multiply it by a percentage. And that percentage is what the company thinks is their best guess. It's based on their history. We think of that $1.6 million, 1% is not going to be collected. So let's see what they did here, okay? You take the net credit sales times your percentage. That's all you do. So here we go. Kids Clothes had credit sales of 600,000. Based on their experience, 1% is no good. 1% is no good. So that looks to me like it's be what, $6,000? Let's take a peek. There you go. 600,000 times 0.01 equals 6,000. Now prepare the journal entry. This is our month-end adjusting journal entry. Do you remember what we debit and credit? We debit bad debt expense and we credit the allowance. Not so hard, huh? The sales method's super easy. The sales method, we're just going to take whatever those sales are for that month, and whatever number we get is the bad debt expense. Under this method, we do not care what the balance is in the allowance account at this point in time. We don't care in terms of this entry. Under the sales method, we're just going to layer this $6,000, and if this was $50,000 last month, it's now gone up to $56,000. So this is your adjusting journal entry under the sales method. And one problem with this is, since you're only looking at 1 month at a time, suppose 3 months ago, you only put 1% in, and then unexpectedly, a big customer of yours went bankrupt. And you're just learning about it now. You will not have an adequate reserve. So this is why the next method is the best way to do it. And I'm going to almost guarantee most companies do this, okay? This one takes a little more thinking, but the journal entry, the debit and credit is the same. The numbers might be different, and the treatment is different. So let's see what we have here. Here, we're going to determine the balance in the allowance account on the balance sheet. We're going to look at the aging. Under this method, we're reinventing the wheel every month. We're not just looking at 1 month sales. In fact, we're not looking at sales at all. We're looking at our aging, and we're looking at each column of the aging. And maybe our policy is, if it's in the 1 to 30 day overdue, our experience is we won't collect 1%. 31 to 60, maybe 3%. As the debt gets older and older, it's less likely to be collected. So here, we do care very much what's in the allowance account, because this calculation will give us the number to replace it. And let me see if I can make that clear here. So let's take a look at this. Okay. Take a peek here. Here's our aging. It goes from Aaron to Zach, and there could be 1,000 customers here, but they're just showing a couple of them. So let's take a look at this. Our total accounts receivable is $10,660. $10,660, okay? Now, we look at each one individually. Let's see. Aaron owes us $235. It's not yet due. It's a little bit overdue. And we use the following thought process. If it's not yet due, we think we're still going to lose 1% of that. When it gets to 1 to 30, we're going to lose 4%, 31 to 60, 10%, etc. We multiply these out, 35, we add it across. That number there, the 1201, which you just calculated, please try to understand that that is not the bad debt expense. That's not the bad debt expense. That is the total estimate we want in the allowance for doubtful accounts, okay? Which means we have to care very much what the balance in the allowance for doubtful accounts is when we make this entry. So how much do we want to have in the allowance at month end under this aging method? In this case, it's 1201, $1,201. So let's see what the journal entry is. Well, we know we wanted to have 1201. There's our famous 1201. That's what we want the allowance to be at the end of the month. But we already had a credit balance in there of $50. So how do we get from 50 to the desired 1201? By subtracting the difference. And there's your journal entry. Again, it's a debit to bad debt expense, credit to the allowance, done just once a month, okay? 1151. So we post, and here's what we're looking at. Take a peek here. T account, here's your general ledger. The balance was 50 to begin with. This is what we need it to be at the end. The difference is a credit. Allowance for doubtful accounts. I'm going to get a little ahead of myself here and point something out, and I hope you listen carefully. Anytime you credit the allowance for doubtful accounts, you automatically debit bad debt expense. No exception to that. So if I said to you, what was the debit to this journal entry, you know it's bad debt expense, because the only time you credit the allowance is when you're debiting bad debts expense at month end as an adjusting journal entry. What if you see a debit here? A debit here means we're reducing the AR and thus reducing the accounts receivable. So any debit to the allowance account is automatically a credit to accounts receivable. So that's a note I'd like you to stick in your head. So when you're on the test, you see a T account, you can sort it out a little bit easier like that. This credit entry here is only done once a month. We debit bad debt expense, we credit the allowance. Here, these are the write-offs. Here is where we know who's not going to pay us. We could be doing these every day. Many years ago, back in the early 70s, I was a new guy with the company, and one of the little jobs they gave me was the AR aging. And every day it would come off this, we'd get a printout. It'd be a big, long green, paper, 25, 40 pages. And my job was to go through each column and circle what I thought needed to be written off. And we had some policies on that. Any debt over, say, 120 days, but under, I don't know, $100, say, we would automatically write off and turn over for collection. Keep in mind, just because you wrote the debt off doesn't mean you stopped trying to collect it. It just means accounting-wise, you were obliged to honor GAAP rules and show that reduction in your aging. Worst comes to worst, you send it out to a collection agency, and maybe they can salvage a few dollars for you, take that chore away from you. Okay. Aging of accounts receivable, huh? Aging of accounts receivable. The accounts receivable times the estimated uncollectibles equals the amount we want in the allowance account, okay? And all they're doing here is trying to confuse us. They're just saying, look, if it has a credit balance, it's the difference. If it's a debit balance, we have to just add it back. Whatever you need to do, plus or minus, to get it to 1201, okay? Now, that's the hardest part of the chapter, I think, the allowances, the allowance for bad debt expense and the write-offs, okay? Let's go back now to our net sales calculation, recording credit card sales and sales returns and sales discounts. Decker's credit card sales for sheepskin boots were $3,000. The credit card company charges 3% service fee. Okay, so they had a sale. And remember, contra discounts are always reported as a contra revenue account. And there's our journal entry. I went in, I bought these $3,000 pair of sheepskin boots, which are very comfortable, by the way. And I swiped my credit card, and the shoe store, Decker's, they were able to, their system immediately created this journal entry. They credited sales revenue for the price of the shoes, and they gave away the 3% fee, $90. So the cash they received is $29.10. Your book is showing accounts receivable. It's really not. It's cash. It's really cash. Accounts receivable is not really the right term there. You maybe call it credit card receivable, but the cash is transferred so quickly. It's cash. That $29.10 debit cash. Okay. Sales discounts. Now here we go to our 2%, 10, net 30. Remember, we sold boots. The terms are 2%, 10. You get a 2% discount as long as you pay within 10 days. You don't want the discount, then just pay the net, the whole amount in 30 days. Pretty simple. So let's look at the sale, basic sale of $1,000. Wow, that's not too tough. We're back in chapter 2, I bet, on chapter 1 even. We sold boots on account. We debit accounts receivable. Decker's, this company, whoever we sold these to, owes Decker's $1,000, and there's our revenue, okay? You notice there's nothing to do with the discount in here. You don't worry about the discount at the point of sale because you have no way of knowing if the customer is going to take the discount or not. You have to wait and see what happens. So what happened? They got paid on the 14th. So that's well within 10 days. So look at the journal entry. You're going to figure out the 2% of 1,000 is 20. So there's your debit to sales discount. There's your debit to cash. And what do you think the credit's going to be? Accounts receivable. Accounts receivable. This customer owed us $1,000, but we gave them the opportunity to settle that whole $1,000 with a cash amount of $980. So the customer saved himself $20, and we suffered a loss of our net sales of 20, if you want to call it a loss. Sales discounts. What happens if the party pays you on the 20th? Well, after 10 days, what entry would you make? Well, since the customer paid outside of the discount period, sales discount is not granted. Okay. Now, in the real world, be very careful of going after customers who take a discount early, because you can do more damage in your relationship by chasing people down like this. My example is this. You have a very good customer who's been buying from you regularly for years. You're their only supplier of a certain item, and they always take the discount, and they're always on time. Once in a while, maybe they're a few days late, and they still take the discount. Are you going to go after them for that $20? No, you're probably not. You're going to ignore it. My point is, you got to use a little bit of judgment here. And I saw one time one of the young guys in the office, he called up somebody and told them that he was going to charge him the $20, and this longtime customer went nuts. And Fortunately, we salvaged the relationship. Sales, returns, and allowances, huh? Before paying, a customer returns $500 of boots. What does that mean? He returned the left shoe? I thought he only bought one share. Okay, but he's returned $500 pair of boots, okay? The boots originally cost Deckers $300. So the $300 is Deckers' cost of goods sold, right? Deckers bought those boots for $300 and they sold them for $500. So now the boots are returned. The boots are returned. What is our journal entry? Whoa, look at this. We got 2 journal entries. How'd that happen? Well, when they returned the boots, they don't owe us $500 anymore. That's the whole point of returning the boots, that we don't have, that customers not expected to pay that anymore. So we reduce the accounts receivable and we reduce the net sales via the contra revenue account, which reduces your revenues and of course will eventually reduce the stockholders' equity. But what about the 300 here? We have to reverse that too. When we sold these boots, we debited the cost of goods sold for 300 and we credited the inventory for 300. So remember, it's important to do the second part of this journal entry, which is you debit the inventory, credit cost of goods sold. We're putting this $300 pair of boots back in the inventory. And you want to know why? God forgive me for this bad joke. We're putting it back in the inventory because these boots are made for walking, and that's just what they'll do. Now, how many of you have never heard that song before? Oh, goodness. Never heard that song, These Boots Are Made for Walking? You young guys. Okay, now we get into some more fun stuff. This is a pretty grueling chapter. I think you'll agree. Chapter 6, 7, and 8 are not terribly hard, I don't believe, but there's an awful lot to be learned, okay? We know what cash is. Cash is coins in our pocket and bills and checks, direct deposits, wire transfers, bank drafts, T-bills, certain certificates of deposit under 3 months or so. And you must have good internal controls. We talk a little bit about internal control, right? You protect your assets. And you want to do everything you can to protect the most stealable asset, which is your cash. And you have to safeguard them with certain procedures. And they're making a note here. Cash is the asset most susceptible to theft and fraud. Who knew, huh? One important thing in controlling the cash, it could be something as simple as any cash that's in the office is always locked up in a safe. That's an internal control. Any cash on hand at the end of the day is deposited in the bank. So you don't end up with a big pile of cash for somebody coming and nip, okay? But probably the best thing you can do on top of that is segregate the duties. In other words, the person who opens the mail, maybe that person is allowed to just do that. And then he or she gives the checks to a person who then enters them into your accounting system. And then a different person takes the money to the bank. And then a different person might do the bank reconciliation. By separating those duties, you greatly reduce the risk of somebody stealing from the company, okay? It would take 4 people in cahoots. I'm going to tell my famous story, and you guys are probably too young to remember this, but it wasn't that long ago. There was a big story in town where a woman working for the Santa Barbara Police Department ended up getting convicted, and now she's in jail for theft from the police department. She was a graduate of a local high school, and she was a hard worker, and she got promoted and promoted. She did very well, had been with the police department a long time. She was honest as the day is long, as we say. But they trusted her so much. They said to her, whatever her name is, Maria, why don't you open the mail and collect all the parking tickets? We're putting you in charge of the parking tickets. All the parking tickets are going to be coming to you. You record them in the computer system, and you collect the money, and you control everything to do. Well, this poor woman was tempted too much. When she realized she had all these all these assignments to herself. She set up a scam where I would get one of those pesky $40 parking tickets downtown. I would mail the money into her, payable to the Santa Barbara Police Department. She would get that, go into the computer system, which she was now empowered to control, and she would remove my record. So there was no record that I ever got a ticket. And then she would take that check and put it into her phony business called maybe Santa Barbara Protection Agency or something. The point is, she was tempted, and it was a big, big story out here when they finally caught up with her. But maybe the most important internal control for cash is to prepare a bank reconciliation. A bank reconciliation. This is something that you and I should be doing every month with our checking accounts. And I'm willing to guarantee most of us don't do that. Well, we really should, because when we do this and successfully do it, we have confidence that nobody's stolen anything from us or there's no mistakes. Businesses really should be doing these regularly every month for good reason, as you'll see. Okay? Bank reconciliations. Bank reconciliations. It explains the difference between the cash reported on the bank and per the book. Explains the difference between the cash reported on the bank statement and the balance on our checkbook, on our general ledger. So what we're going to say to ourselves is, at the end of the month, that we got the bank statement. The bank statement says we have $4,000 in the bank, okay? We compare that to what our books say at the same exact point in time, and we don't have 4,000 here, we have 25,000 here. Does that mean we have a problem? Probably not. Probably not. Probably the difference is in the word timing. There are transactions which we have recorded that the bank doesn't know yet because the check is literally in the mail, okay? We have what's called deposits in transit. A deposit in transit is a customer check we received, entered into our general ledger, but that check has not yet cleared the bank. Perhaps these deposits in transit were recorded in our books on December 31st, and then you put it in your drawer and you came back to work maybe 5 days later and then took it to the bank. Well, that's going to mean that that bank balance on December 31st is not going to have this information. So we on paper in our template, we have to tell the bank that we had this deposit in transit and this one. Outstanding checks are similar to deposits in transit, except these are checks we wrote to pay our bills that have not cleared the bank. Outstanding checks. You know, I work for your company, and maybe on the 28th of the month, you reimbursed me $15, say, for parking at a trade show or something. And you cut me a check for $15, and I stuck it in my wallet and forgot about it for a couple of weeks. Well, when the bank statement comes out, that check is not going to be on the bank statement. So we have to subtract that. So your template that you really have to have in your head here, on the bank side, we're going to take the bank balance at the end of the month, add the deposits in transit, subtract the outstanding checks. The example we're going to see has a bank error, but you're not going to have bank errors on your test. Believe me, anytime I had reason to think I needed to question the bank, I lost. The bank was undefeated. I never once caught a bank in an error. We make the errors. We're humble enough to say it's the company that makes the errors. An important point on the bank side, no journal entries are done on the bank side, but the book side, the general ledger side, anything you see here requires a journal entry. And that's because these are things we're learning from the bank statement. Over here on the bank side, We're telling the bank on paper, hey, you didn't get those deposits in yet. You didn't get these outstanding checks in yet. So this is what your balance should be. But we're doing the same thing on our side now, except we're looking at the bank statement. Uh-oh, the bank had a deposit we didn't know about, perhaps a direct deposit or a wire transfer. They charged us for printing. They charged us a service fee for some reason. Maybe it's a monthly fee. An NSF check, non-sufficient funds check. Some customer had the nerve to send us a check when they had no money in their account. And we didn't know that until we got the bank statement. And then book errors. Yes, we can make errors. The bank is infallible, as far as I know. So let's go through a bank reconciliation here, and we'll pretty much close up this chapter, okay? Bank reconciliation. Well, let's see what they're telling us. Prepare a bank reconciliation and statement and the journal entries for the Simmons Company. The bank statement at the end of July had 9610. The ledger or checkbook had 7430, okay? And then they're giving us some other information. They're giving us the outstanding checks. They're giving us the outstanding checks. They're telling us that this is a deposit in transit. A check mailed to the bank for deposit had not reached the bank. Here's a bounced check. We found this out when we looked at the bank statement. The bank statement showed $30 of interest income. We didn't know that until we saw the bank statement. And it looks like we made a mistake, not the bank, huh? We wrote a check and we recorded it in our accounting system at 240. But when we wrote the check, we wrote it for 268. Now, don't ask me how you can make that mistake, 268, 240. It can happen. So the check was actually written for 268, but we wrote it up as if it was 240. And then the bank made an error, and we'll see that. So we have two balances. They're giving us these two balances to start, and here's your template. Here's your template. I would write this down in your notes when you summarize, if you summarize the chapter yet, maybe draw this out in your notes and have this grid in front of you. The bank side is pretty easy. The bank side is simply the balance per the bank plus the deposits in transit minus the outstanding checks. So we start our reconciliation like this. You put in the beginning balances, okay? Let's see what the next step might be. Wow, they did everything for us, huh? Let's look at the bank side. Remember, they told us that we had $500 deposits in transit. They gave us that number, and they gave us the outstanding check number. So your whole template is simply bank balance plus deposits in transit minus outstanding checks. Now here, the bank made an error in this example, which is kind of absurd. Well, it can happen, I guess. A $486 deposit by the Acme company ended up in our company. We're the Simmons company. It's not like we're the Acme 2 company. So we looked at our bank statement. We look at our bank statement here, and holy cow, what is this $486 here? And we check it out, and we realize this is not our money. And we're honest people. So we put it on the bank reconciliation. And what you would do is contact the bank immediately. Perhaps a text or call your contact and say, look, you gave us $486. Thank you very much, but it's not our money. Could you please remove this from our checking account balance? So bank side's not too bad. We'll go back up here one more time. Now, these last three items here are the things we picked up from the bank statement. These have to go on the book side. Bounce check 225, 30 in interest, and that silly 268, 240 controversy. So let's take a look. Our beginning balance was 7430. Let me get rid of that. Beginning balance was 7430. Forgive me, guys. We add to the 7430 the 30 in interest. We subtract the NSF check. We have to subtract it. That's $225 that we put into our general ledger. And the bank says, you don't have that money anymore. You never did. And then the $28 was the difference between the 268 and the 240. And it is an error that results in us losing $28 more, if you want to say it that way. We thought we only spent 240. We actually wrote the check for 268. All right. Now we got to write journal entries. Remember, bank stuff, bank side, no journal entries. Here, we're going to have to record interest income. Here, we're going to have to put the 225 probably back into AR, right? When we received this 225, we debited cash and credited accounts receivable. Well, when this check bounced, the guy owes us the money again. So we're going to reverse that. And the 28, you would just debit whatever you bought in the first place. So let's look at the journal entry. Not too tough. Cash, they did the one plus here. You debit cash, interest revenue. Thank you, bank. That's $30 we found out was on the bank statement. And here we're going to debit supplies inventory because that's what they bought originally. They were supposed to debit supplies inventory for 268 and credit 268. Now they're just correcting for that. And the AR, the bounce check, you debit accounts receivable and credit the cash 225, which is how you end up over here. Every adjusting journal entry from a bank reconciliation is going to have either a debit or credit to cash. Okay? And I used to like to put that true-false question on the test. True or false? Some bank reconciling journal entries will not necessarily touch cash. No, they all do. That's the whole point of bank reconciliation. Okay? Well, we're not quite up to here yet, but I'm going to go back to the bank rec one more time. So why is this so important here? When we have this thing balanced so nicely, like you see here, you know that every penny has been spent the way you wanted it and that there's been no chicanery. No chicanery. Now, suppose you're doing this and it's the end of the month and you end up with a bank balance of 7207 and you know you prepared this bank reconciliation absolutely correct based on what's in the general ledger. You know you did. And yet you end up with a bank balance of, say, $2. Well, hopefully it's just a mistake that somebody made, but it could very possibly be somebody has stolen $7,000 or whatever that difference is. And you may not know it for a while. That's why you need to do these bank reconciliations, especially the bigger the company. So you look at that, you say, oh my goodness, 7207 bank, and we only got 207 here. We're 7,000 off. And your first reaction would probably be, just probably a mistake. Who's been doing the bank reconciliations? Say Maria. And you go say, well, ask Maria to come in and maybe she can explain this. And you find out Maria's taking a leave of absence and she's going to be spending time in Afghanistan. In other words, you've been robbed, okay? Why does this thing keep popping up in front of me? I don't like it. Okay. Now, you will be doing the FSA shortly, okay? You're going to be doing two companies, probably General Mills and Kellogg's, two of the largest cereal producers in the country. They're both international. They're both similarly sized with similar product lines. And part of your first FSA, financial statement analysis project, is going to be this. You're going to figure out for me the receivables turnover and comment on it, okay? If you take your net sales, divide them by the average trade sale receivables, not cash, not cash, only the credit sales. You divide this out, and you're going to get what's called the turnover. And that simply means how many times you collect the average receivables each year. Okay. So they're giving us the numbers. We had net sales, credit sales. That's important to remember. Credit sales of 689 million. Our beginning AR was this, our ending was this. We divide it out and we come up with the turnover, 7.6 turns. Well, you compare them to other shoe companies, we're exactly the same as Timberland, and we're a little bit better than Skechers. 7.6, what does that mean? That's the number of times you collected the average receivables. Now, if your experience is like mine and you go into those meetings every month and the boss wants to talk about receivables, if you tell him or her, oh, I got good news, boss, the turnover was 7.6, that person's going to ask you to speak English. They may not know what you mean by receivable turnover. That's jargon. So here's what we're going to do. We're going to say to ourselves, we're not going to go into that meeting and talk 7.6. We're going to talk days. 365 days in a year divided by the turnover gives us 48. Gives us 48 days. 365 1 year divided by the turnover gives us 48 days. This tells us that this company collects cash 48 days after selling their product. Okay? Whether that's good or bad, I guess depends on the company. Obviously, you'd like to have this day, lower and lower, and you want the turnover to be higher and higher. So that's one part of your FSA. And when you get to chapter 7, when we get into the cost of goods sold and inventory costing, you're going to change this from net sales to cost of goods sold, change this to inventory, and you're going to come up with the number of days it took to sell the product, okay? Average collection. That is the end of the chapter. So it's about time for me to wax my surfboard and get out there in the ocean. And I hope that you were able to see all the slides. And how about somebody actually show up next week, huh? What are you guys all doing at 3 o'clock that you can't join me and have a little back and forth, okay? Anyway, keep it up, guys. Looks like you're doing real well from what I'm seeing on tests and the homework assignments. Just keep going. It's a tough chore doing this all in a short time, but it looks like we have the group that will succeed. You take care now.